Hello, everyone, and welcome back to day 65 of our 365 Days Life Challenge. Today, we are diving into the world of fixed income investments in India. If you are joining us live, drop a comment and let me know from where you are tuning in from. All right, let's get started. Fixed income investments are an essential part of any well rounded investment portfolio. They provide stability, regular income, and can be a crucial component of wealth building strategies. So, what are some of the options available to investors in India? So, what are fixed income securities in India? So, let's look at all these questions which may arise in your mind. Fixed income instruments are the debt instruments issued by government or corporate organizations, means the companies, that offer a fixed return on your investments. So there are different types of fixed income securities, including mutual fund, treasury bills, bonds, national savings certificates, and so on. So specific securities even provide periodic returns to create a steady income stream. Due to the fixed returns, many investors prefer these fixed income instruments in their investment portfolio. So, even if they are having equity linked and other linked investments, they prefer fixed income investments for this reason. Well, there are several avenues to explore. Many types of fixed income instrument options are available to Indian citizens. Let's discuss the different types of fixed income securities one can have in their portfolio. First one is a debt mutual fund. These funds pool investors' resources to invest the corpus in various debt instruments such as bonds, treasury bills, and other fixed income securities. So, second one can be the treasury bills. These are short term fixed income instruments issued by the government for 91 days or 182 days or 364 days, and they do not carry any coupon, means the interest payment. They are issued at a discount on their face value. The face value is paid to the buyer on maturity. For example, see a 91-day T-bill with a face value of rupees 100 could be sold at rupees 98.4. That means the gain of 1.60 is released on receiving the payment of rupees 100 on maturity. Third one is bonds. Bonds are fixed income instruments that are popular worldwide and offer predetermined returns. They are standardized and are fungible units of the loan raised by either government or by the corporates. It is for a specific objective. The lenders are the investors who buy the bonds, and the borrower is the company or the government who is issuing these bonds. The fourth familiar is the National Saving Certificate. These are the saving certificates you can buy from the nearest post office. They have a fixed maturity period of 5 years and a fixed interest rate. Apart from guaranteed returns, they also offer tax exemption for investments up to rupees 1.5 lakh. This is under Section 80C of the Income Tax Act. The fifth one is a money market instrument. So these are, I'm just giving you a list of the instruments which comprise of fixed income securities with a maturity period of less than 1 year. So they can be certificate of deposit. A certificate of deposit, popularly known as CD, is a money market instrument issued by the bank that guarantees repayment of the principal along with the pre-specified interest rate. This interest rate may be fixed or it can be floating. A CD has a maturity period which is ranging from 7 days to 1 year. It's available only in demat form. CDs are generally issued by, or they are governed by RBI and having a minimum investment amount of rupees 5 lakh. Second type is commercial paper, which is known CP. It is a fixed income security issued by large companies to meet short term liquidity obligations. It is floated at a discount and they are redeemed at face value on maturity. Now, let's look at the advantages of fixed income securities. The first one is a consistent return. The returns from the fixed income securities are predetermined. You know them in advance. They offer consistent returns. Moreover, the risk of return fluctuation is minimal due to lower variance than the other instruments like equity and all. So the second advantage is relatively low risk. Since many of these securities are backed by government or large banks and big corporates, they carry a relatively lower risk. However, you should always do your due diligence and check the entity's profile before investing into that. Third advantage is diversification of portfolio. As discussed earlier, it has been seen that there has been an inverse relationship between the returns from the fixed income securities and the other equity instruments. Thus, adding fixed income securities to a portfolio balances the risk profile and it is also more weather resistant. Fourth one is higher priority of being paid out in case of bankruptcy. In case the issuer means the company goes bankrupt, the investors in fixed income securities get a priority in being paid back before the other stakeholders. So the senior secured debt holders get paid first, followed by the other investors. The equity investors and the promoters are the last parties to be paid. Fixed income securities are known for their stability and the regular income streams. However, like every investment, they also come with the several disadvantages like lower potential returns, liquidity risk, credit risk, reinvestment risk. Now let's look at them one by one. First one is the lower potential return. These fixed income instruments often provide lesser potential profits than the equities or the real estate. Second one is liquidity risk. Some fixed income instruments, particularly those with lower maturities or worse credit quality, may be difficult to sell rapidly without losing the value. Third one is the interest rate risk. If the interest rate increases, the value of these securities, which is carrying a low interest rate, may fall or may decrease because there is a less demand for them. Fourth one is credit risk. Even while this risk is often low for the government assets, the issuer could stop making the payments. Fifth one is a reinvestment risk. Risk exists when interest generated won't be able to be reinvested at the same rate. Now let's ponder on why should you invest in fixed income securities. So as mentioned earlier, investors have different needs, different risk appetite, and different financial goals. Those looking for secure returns without tracking market fluctuations, irrespective of earning potential, they should invest into fixed income securities. In such cases, people who are creating a corpus for their child's higher education or maybe for family members' wedding, they will be investing or they will be most inclined to take minimal risk with their investments. Fixed income securities will be a suitable instrument for them. Also, a person who requires a stable income can consider investing in fixed income securities. So, for instance, people who are nearing retirement must create a source of regular income even when they stop working. They can invest in different types of fixed income securities option that offer fixed payments at regular intervals. For investors with a higher risk appetite, fixed income instruments are still an option to diversify their portfolio. To put it simply, including fixed income securities in your portfolio can be helpful in balancing the risk which is associated with equity investments. Let's understand the working of a fixed income tool. with an example. Mahindra and Mahindra Financial Services, which is known as M&MFS, launch bonds with a face value of 1,000 and the maturity due is 7 years. The coupon rate on the same was 8.53%. The company planned to repay its bond. What are they going to do? They are again going to release some bonds and generate the profit in the coming year to repay the bonds. Therefore, if you bought, say, 10 bonds, you will be entitled to annual payment of 10 into 85 into 3, which is 853 till the bond's maturity. These payments are your fixed income for the next 7 years. At maturity, M&MFS repays the bond of 1000 into 10, which is 10,000 to you, along with the accrued interest. The interest for this period is 7 into 853, which is 5971 as a total interest as a total interest. So you're going to get 10,000 plus this interest. So before we conclude, let me ask you this question. Which fixed income option do you find most appealing and why? Drop your thoughts in the comments below. So, all right, so that's a wrap for today's session on fixed income instruments in India. I hope you found this information valuable. Join me tomorrow for another exciting topic. Until then, stay curious and keep investing. Take care. Bye bye, everybody. The link for the upcoming session is provided in the comment box. You can check the details and join for it. Bye. See you tomorrow.